Hello and welcome to Leaders of Tomorrow. This is a special series we're doing around Diwali 2021. What should you be doing with your money in 2022? How is Diwali 2021 perhaps going to make you richer? How should you be managing your money better? And also, what are the indicators as far as the macroeconomy is concerned? All of that we'll be discussing on tonight's show. Let's dive right in then and introduce our guests. First up, we have Chandresh Kumar Nigam, MD and CEO of Axis AMC. Also on the show, Radhika Gupta, MD, Edelweiss Mutual Fund. Let's discuss international funds, Chandresh. What is the rationale for an investor to perhaps look at this segment of the market? How does an investor going about doing this? Is it a good idea for an investor to be looking at these funds? What would you want to tell us?
Globally, if you look at it from an investor's perspective, traditionally also, for markets, let's say closer to India, whether it is Singapore or Hong Kong, Indonesia, Korea, Taiwan, I think investors have already over the last 20, 30 years begun to allocate anywhere from 20 to 40%, in some cases even more, to global markets and home markets for their own countries. The allocations have been steadily coming down. Now in India, because India was always part of a very fast-growing emerging market framework, we in the industry as well as fund managers always thought India will do much better and there was not much need to diversify. I think with the last slowdown beginning 2015-16, I think that thing has changed. So along with the opportunity, along with the higher growth and the risk, it now becomes important for investors to slowly start allocating to international markets as well. While Indian markets will provide enough growth opportunities, we are there. It's an emerging market. We will grow fast. But there are many opportunities which are not available in India, especially in the tech space and the biotech space, and there are many other areas that one can talk about. So I would think investors should begin. There's no point saying that investors should certainly put 30% of their money in international. As a country, I think we have less than 1% or so. So maybe over a period of time, 5, 10, 15% over the next 2, 3 years, investors should start to look to invest in high quality, again, high growth international funds, where the underlying is a little different. The kind of industry exposure which you get is a little different from what you get traditionally in India.
I want to discuss balanced fund category. What would you like to tell our viewers about this?
So this is one category which allows investors who are a little bit more risk averse and hence may not want to participate in equity markets. I think this is one of the best instruments or vehicles which allows you to have a relatively more restful night. You can sleep easy. At the same time, gives reasonable exposure to the upside potential in markets over the medium to long run. Additional benefit is the fund managers, in case the markets turn too volatile, the fund manager can take a call in terms of adjusting the exposure to equity. So for example, last year when the COVID crisis struck, I think the markets fell 40%. And there was obviously good opportunity. So many of the balanced fund category fund managers actually increased exposure. And as the markets have gone up over the last 18 months, slowly that exposure has been trimmed. So what this category of funds is doing, one, the overall risk level is lower. So investors can take a longer term view and comfortably stay with these assets. On the other side, it allows fund managers to add some kind of a improvement to the return outcome at a lower level of risk. That's important. By taking advantage of some of these market dislocations or opportunities if they arise. It may not be always possible, but whenever there are very sharp movements, I think there is some ability to do that. So both these things, I think successful investing is about investor managing his sentiment and staying in the markets for long, as well as on the investing side, the fund manager being able to do the right thing for the investor and having the time to do that. I think when these two come together, that's when we see really good outcomes for investors. And the balanced advantage category is one vehicle, I would think, which allows both these things to really happen.
So when it comes to investments, how do you personally perhaps decide that this is a good investment, it's not, and based on that, could you tell and help our viewers understand how they should perhaps be going about deciding for themselves that something is a good opportunity or not?
I'm always a firm believer of investing regularly, steadily, because it does, as I said in answer to the previous one question, it's also about managing your own sentiments and behavior. Investing and wealth creation is something which is very serious business, and it has no place for your sentiment which will get swayed day on day. So getting into a disciplined investment approach, invest regularly, stay for the long run. I don't think while we all think Diwali is a great time and let me do and trade and all that, which is fair, but that doesn't mean that we kind of trade in and trade out with all our money or the entire portfolio. Portfolios have to be built over a period of time, and the one thing which I would wish for every investor and every entrepreneur is to get that approach and discipline going, because if you really get that going, you will anyway end up doing better than more than 90% of all other investors. Invest regularly, stay in the long run, for the long run, and invest in high growth quality businesses which have generated wealth long period of time. I think you will really build, along with your businesses, really build another avenue for wealth creation and a sizable corpus over a period of time.
So for someone who's a first-time investor, we were talking about how the markets have run up and they're saying, I've missed most of the rally. What advice do you want to give them?
Even if you've not started off now, doesn't mean that you shouldn't start just because the markets are up. As we all know, not taking that risk and not taking that jump into the markets is the biggest risk you take. But there are these strategies of minimizing or controlling that risk, or in some cases, actually exploiting the volatility or the downtrend which may come in, and which is by investing regularly over a period of time.
All right, Chandresh, thank you so much for your time. I'm wishing you, your family, your team a very happy Diwali. Let's slip into a short break. When we come back, Radhika Gupta of Edelweiss MF joining us in our second segment. To stay tuned, back in just a moment. Let's talk about what's happening on the IPO side of the market, Radhika. We just did a series of special interviews here on Leaders of Tomorrow that we call the IPO Gold Rush, because so many entrepreneurs, and it seems almost like a pent-up sort of a demand or a need. All of 2020, most of 2021, this huge rush of IPOs that have happened in the market. What view do you have on perhaps some of the valuations, some of the sectors that we've seen? What do you want to tell us?
So one, I think I've never seen an IPO rush like this, a time when 5 or 6 companies are listing in a single day, when our analyst team spend just days looking at the number of DRHPs being filed to figure out which ones they want to study. I don't think anyone has seen anything like this. Now, we run an IPO fund, and I think even before this year, we've always believed that IPOs will be an important structural trend for India. There are 2 reasons. One is that a lot of capital did enter India via the private markets, and that has looked for an exit. Obviously, the times have become better to exercise those exits now. The second is, I think our listed markets still don't represent many sectors of the economy. So Your largest exchange is still not listed. A lot of retail players are not listed. A lot of technology-driven business models are just coming to hit the market. So this is reality. So I think IPOs as a structural theme absolutely continue. And you have, I think IPOs also represent, as you very correctly said, the new age economy. So while the old age indices were IT services, you suddenly have, e-commerce, gaming, insurtech, etc. While the old age financial services was bank, you suddenly have a lot of asset light, fee-based insurance, asset management models. As far as valuations, I think it's a mixed bag. In this market, I don't think you're going to see IPOs coming in at cheap valuations. I do think, however, Sunanda, that you can't apply the traditional valuation metrics to the IPOs that come to market. So we have grown up in some way on it. And I said this when, the IPO of a prominent food delivery company came out, that, the traditional metrics in terms of price to earnings in a market where people have 30, 40, 50% market share, they may not be the most accurate ones. In that sense, some of these stories are binary. Either you become a dominant player in the market and your valuation is probably much larger than what it is, or it fizzles out. So I don't think the traditional metrics apply. But ultimately, I will also say that the listed markets reward you for making money doing something sustainably.
My question is that global analysts are sounding a note of concern about the way the stock markets have run up here in India, and are saying that perhaps it's very highly valued compared to what's happening with their global peers. How are you really reading all of this market action, Radhika?
So one, I would say India is not cheap compared to global peers, but valuations have to be seen in the context of a broader economic recovery. If we are and the highlight is if we are at the beginning of a revival in earnings cycle from 10-year lows, then valuations to that extent will moderate over time. And I think people are pricing in that FY23, FY24 kind of recovery. So that's how I see valuations, but I would still say that India is not the cheapest among its global counterparts. Markets like China, for instance, have corrected substantially and have become very cheap at this point of time.
Sure. So what's your advice then for not an entrepreneur, any investor who's looking at the markets and wants to create wealth for themselves, for their families, both perhaps in the short term as well as in the long term? What is your advice?
I think a couple of things. One, pay attention to asset allocation in your portfolios. I think if you have to err on taking risk or on the side of caution in this kind of market. So if you were comfortable with 40% equity in your portfolio, or on the side of 30 to 35. Secondly, increase your time horizons from equity investments. That's extremely important. One of the things that has happened in these markets is that people's time horizons have become condensed because they see 5, 7, 10% gains in a month, and it makes you very, very short term. I think if you're investing at this point, equities is not a 2-3 year game from here. Sitting in 2008, it could be, but from here it is not. It is definitely a 5 to 7 year game. And thirdly, I think in this market, it is very important to have a sharp eye on quality. As we look at individual names in the market, names can run up for all kinds of reasons. And there is a tendency to compromise on quality in markets like this, which is very, very important to keep in check, because if there is a correction, and when there is a correction, of course, it is the lack of quality that gets hit the hardest.
Okay. So debt versus equity then, what sort of a balance should you have in your portfolio? What's your advice?
It's very, very individual. I mean, in our own balanced fund, we run probably a 60-40 mix, but it is very, very individual. I mean, my own portfolio is probably closer to 60-40 as well. But definitely have an element of fixed income in the portfolios. It's interesting you mentioned debt versus equity. A lot of consumers come up to us and say, why do we need to hold debt? What we'll get in debt in a year, we'll get in equity in a month. And that is a sign of the time. So don't fall for that. Debt is the hedge in your portfolio. It keeps you going when there is an equity correction. And one of the things that has happened in this market is a lot of first-time investors have come into this market. Since March 2020, the number of new demat accounts, mutual fund folios, I mean, any of these statistics that you look at, a lot of first-time investors have come into the market, and I call them children of a bull market. They haven't even seen a 5-10% correction. In fact, the recent correction that we've seen in mid and small caps is probably the first one. So their ability to withstand that also needs to be tested, which is why debt is a very important component.
Okay, you were talking about asset allocation earlier. You mentioned that. So it brings me to my next question. Since you're saying 60-40 typically is the sort of split you should have in your portfolio, what do you do if your equity component has run up, in correlation to what's happening in the markets? Also, you were talking about gold and, not so much physical gold, say, for instance, sovereign, debt bonds, if you have in your portfolio, for instance, what should be an ideal mix that you think an investor should have for the long run?
So I think one, if any asset class in your portfolio has run up beyond your allocation, now whether it's 60-40 or 50-50 or 40-60, you should periodically rebalance it. Now it could be once in 6 months, it could be once in a year. In a tax efficient way, you should rebalance it. So if equity has gone from 60 to 80 and it's dominating your portfolio, you definitely have to consider rebalancing it. The gold allocation, again, this is very individual specific. I think gold is a 5-10% static allocation in most portfolios. And that's the way it should be. I would reiterate, I don't like the idea of timing gold.
Radhika, since we're speaking to entrepreneurs and you were just talking about mid-cap stocks, the kind of rally that we are seeing when it comes to large cap, do you think enough of that is trickling down to the mid-cap, space as well? And if not, how much more of a time do you think it's going to take?
In fact, I think it has started to trickle. If you just take out the correction that we've seen. See, we had a period where large caps significantly underperform mid caps. In fact, I think about a year and a half ago, we had the underperformance of mid and small cap relative to large cap was at sort of historical levels. In the recent bull run, of course, this is substantially corrected. Now it is on those mid-cap companies to really deliver earnings. And that's what we're seeing in the mid-cap segment. If you are delivering on the numbers, then the market is okay with the valuations. If you're missing it, so, if you're a mid-cap IT company who's missing your results, then the market is going to punish you very, very hard. But, outside of the recent correction, I think mid-caps have definitely caught up. And I think in quality mid-caps, we still believe there is an opportunity. We've been telling people to invest in a more staggered way in mid-caps.
Let's perhaps end today's conversation by asking you to speak to our entrepreneurs and anyone who's investing in the markets. The way you invest has perhaps changed because of the pandemic, the way you approach money, the way you're allocating your funds, all of that has perhaps changed because of the pandemic. A lot of people are increasingly looking, for instance, at insurance, while it's not an investment, but as a means of putting their money towards a specific allocation. Insurance is picking up. Perhaps a lot of people are involving their family now in the financial decisions.
Yeah.
What are some of the big changes that you've really seen, whether it's your clients, whether it's your peers, and your advice for someone who's watching today's interview about the lessons that we as investors, that we and as entrepreneurs perhaps have learned from the pandemic when it comes to our finances, how those have changed, what you've seen?
So I think a couple of things in terms of trends. One, as people are getting more aspirational about their businesses, their minds are opening in terms of what they want from their money. I think with each generation, India is getting far more aspirational in terms of money. The openness to try new means of investing, new asset classes is absolutely there. I think in terms of advice, yes, one, the family should definitely be a lot more involved in investing. I think investing is for the family, it's for the women, it's for, older kids. In fact, kids should learn investing early. So investing is finally about goals, right? Personal finance is about goals, and goals are never individual. Goals are family oriented. So definitely involve the family in investing. I think this, second thing is the biggest mistake you can make is having wrong expectations from investing. So understand realistic returns and also understand realistic risks. Always ask what can go wrong, and don't look at the last 1 year as a guidance of what is reality. Look at the last 5 years or look at the last 10 years and understand. I mean, the great thing about entrepreneurs is they know bad times and they know good times, right? And you have to bring some of that wisdom. So have realistic expectations, and I think then the market doesn't disappoint you. And ask the difficult questions about what can go wrong, just as you do in your business. I think that is very important in investing in these times.
All right, completely out of time then on this episode. If you have any feedback for us, Contact details coming up on your screens as we speak. Thanks for watching. Have a good night.